Hi everyone, this is John Lewis with Smart Options Income. Today I want to do a deep dive on a recent credit spread trade that we had on Amazon that resulted in a maximum win. Now what do I mean by a max win? Well, as you know, in Smart Options Income we trade credit spreads predominantly, and the ultimate goal of a credit spread is that both options remain out of the money through expiration, and when that happens they will expire worthless and you get to retain all of the credit that you received upfront without incurring any extra commission costs. So that's the best result that you can get with one of these trades, and that's what happened with Amazon. So let's take a closer look at this trade. We entered this trade around the beginning of February, end of January. The market at that time was experiencing a lot of low volatility. Volatility was pulling back after the big plunge in December. And we were looking for not only volatility, but I also was looking for some bullish exposure because the portfolio was a little bearish and I wanted to have a more neutral stance. So one of the places you like to look for volatility is stocks that just reported earnings. Typically, volatility runs up into earnings, and then after earnings, volatility declines. We call that the volatility crush. But in some cases, volatility doesn't decline right away. So sometimes you're able to get enhanced volatility right after a stock reports earnings. And that's the best of both worlds because you take earnings out of play, and you also have higher volatility that typically is going to go down. So that's what you want to find when you're selling premium. So in this case, Amazon reported earnings on January 31st. They actually blew out expectations in terms of revenue and earnings, but they did have a little soft guidance moving forward in terms of sales, and that caused the stock to drop. But it didn't drop that much. It actually was a rather mild drop for Amazon. Typically, that stock reacts rather harshly after earnings, either up or down. In this case, the stock actually only dropped about 4 or 5%. So on February 1st, the stock was trading right around 1640. It had pulled back a little bit, about 4% or so. But the IV rank remained high. The implied volatility rank was up around 40%, which is pretty good, especially in that environment. It was great. But typically I look for stocks that are above 50%, but really when volatility is low, beggars can't be choosy. So in this case, 40% was good, especially with earnings out of the way. So that was a positive for Amazon. I also like the fact that it was range bound between both its 50-day and 200-day moving averages. Both those trend lines were flat. The stock was basically bouncing between the two of them and really had no directional movement for the previous month. So I like that as well. In terms of the trade itself, we went out to the March 1st expiration and we sold the 1540, 1535 put spread. So this was a bullish spread. And all we wanted was for the stock to remain above the sold 1540 put strike through March 1st expiration. And for that 5-point spread, we were able to collect 95 cents, and that meant we had to put up $4.05 in margin. Margin is simply the width of the spread, in this case 5 points, minus the 95-cent credit that you received. So let's look at that 1540 put, because the key in a credit spread is really the sold strike. So for the 1540 put, that was about 6% out of the money, which is a pretty healthy amount for a stock. And it also had just a 23% chance of expiring in the money by March 1st. And typically I look for sold strikes that have a 30% or less chance. So in this case, we were well below that 30% threshold. Also, I like the fact that the 1540 strike was well below the 50-day moving average. You can see over on the right here, that blue line is the 50-day moving average, and it was right around the 1600 level when we entered the trade on February 1st. This chart is actually from the actual alert when I sent it, so this is current as of February 1st. This is the chart that was part of the trade recommendation. And you can see that the stock is sitting between those two moving averages, the 50-day moving average below and the 200-day moving average above. We went out 28 days to expiration on this to March 1st. Didn't go with a monthly expiration on March 15th. I liked the 4-week expiration because it gave me some diversification in my expirations. I looked at the portfolio and didn't have any trades that expired on March 1st. I like to spread out my expirations, so this fit in well with that type of diversification. And as I said, the goal is for the stock to remain above that sold 1540 strike through March 1st. Now, one of the tools that we provide here with Smart Options Income is the credit spread calculator, and let me show you that briefly for this trade. So this is the credit spread calculator. It's a tool that I use and that subscribers use to put in the parameters of your trade to see if that trade is returning a decent return and how much margin you need, and a lot of things that you need to make sure that the trade is within the parameters of the overall service. So you can see all the yellow spots here are yellow blocks, or where we need to put in our inputs. So let's say we are at just $1 per contract, so I'll put in $1 to enter. Let's say our portfolio size in this case is $50,000, and I usually say that never to allocate any more than 5%, so we'll put in 5%. The width of the trade in this case was 5 points, so we put in 5 there, and we got 95 cents. So I'll put in 95 cents, and the calculator tells me that with this allocation and this portfolio size, I can trade 6 spreads. So let's put in 6 down here. And it spits back a number of numbers. You can see right here the credit I'm receiving, the margin that's required. The maximum return for this trade is 23.5%, and that's based on the credit that you receive divided by the margin that you have to put up. So that's where the 23.5 comes from. The initial credit, total credit, is $570. Commissions of 12 knocks the credit down to $558, which still gives me a very healthy return of 23%. And this is the number you really want to focus on. What's my return after my trading cost? And my trading cost represented only about 2% of the credit that I received, and that's good. We want to keep that below around 10%. The other thing the calculator shows you here is the maximum buyback price, and the maximum buyback price is basically a stop loss. And our stop losses for our credit spreads, and the way we like to trade, is 2 times the credit that we receive. So that means that if the spread moves from 95 cents up to $2.79, that's the point that we want to get out to limit our losses. We don't want our losses to get any greater than that. So there are a lot of things that the calculator shows you, not only what you can receive, but it also tells you how to limit your losses. So let's go back to our trade and see what happened. Well, the up arrow shows you when we got in the trade. The down arrow shows you when the trade expired on March 1st. You can see that Amazon really didn't do anything through the following month. Throughout February, basically stayed between the 50-day and the 200-day moving averages, really didn't have much net movement at all. It did hit a low of 1567 on February 8th, so it did dip below that 50-day moving average, but you can see that it quickly recovered and went above that trend line. The stock closed at 1672 on March 1st, and that represented only a 2% move, which for Amazon is nothing, especially when you're talking about a month-long period. So really, that's a sideways movement for Amazon, and that's perfect. That's beautiful. That's what we want to see, because it kept our sold put well out of the money. The other thing to note for this trade is the IV rank dropped from that 40% when we entered the trade down to 24%. So that shows you that volatility crush that happens typically after earnings. And the spread expired worthless, and we got to keep all of the 95 cents that we collected up front. So that's why we had a max win on Amazon. So what's the bottom line for this trade? Well, the stock traded remarkably flat for a month, and that's perfect for credit spreads. You can't have that type of movement when you're buying premium. You need movement in the right direction, but for credit spreads, we don't need that. All we care about is that the stock stays flat. It can go in our direction, and it can even move a little bit against us. But in this case, the stock was flat, and that was perfect. Horizontal or no movement is a great outcome when you're trading out of the money credit spreads like we do. The spread expired worthless, so we got to keep the full 95 cents in credit, and we got a return before fees of 23.5%. Remember, that's the credit that we received, 95 cents divided by the margin, resulting in the 23.5% return in just 28 days. For that $50,000 account, if we had played 6 spreads, we would have made a profit of $570 based on that allocation on those 6 spreads, which is a pretty healthy profit on one trade for being open just a month. This trade actually represented our 4th closed maximum winner in 2019. Now, we've had a lot more winners other than that. We're having a great stretch right now. But this was one of the 4 trades that actually went to expiration and expired worthless to give us a max winner. So we're having a great start to 2019, and I expect those returns to continue. I can assure you that we'll have plenty more max winners than these 4 for the rest of the year. So looking forward to a great year. Hope you can join us. Once again, I'm John Lewis for Smart Options Income. Thanks so much for watching, and we'll see you next time.